Welcome to the Pennywise Financial Podcast. Constantine here at Monarch Wealth Management with one of my co-hosts today, Dave Georgiev, and a special guest. We have Andrew White from Vanguard. Welcome to the show, guys.
Thank you. Thanks for having us.
Thanks for having me.
Yeah, absolutely. Welcome to upstate New York, Andrew.
That's last time I was here, I got a garbage plate. I think we're gonna
First
skip.
time?
Last time was the first time, and I think that'll be the first time for a long time. My acid reflex is
Serious question though, where'd you get the plate?
I was just gonna ask that.
Bill Gray's.
Okay.
Yeah.
Is that
All
like
right.
a decent one? Is
Yeah.
Okay.
Dude, you can't start a podcast with a garbage plate in upstate New York and not, or Rochester, I should say.
It was, I was told. So I have I have a couple of friends from college who are from the area, but I had a really good friend who she was like, you gotta try it, just do it, and went and got it. And I was told I got the wrong stuff on it. But
Really?
I don't know.
Do you remember what you got?
I did. It was the hot dog. It was
Okay.
the hot dog. It was the macaroni salad.
Yep.
It was the hash browns, and then
You mean home fries?
They
Yeah.
might do hash
No,
browns. I don't know.
It was like
The potatoes.
The potatoes.
Yeah,
Okay.
And then
Home
the
fries.
the cheese and the chili and
Okay.
whole deal.
I'm okay with that.
Yeah.
It's not gonna be my number one go-to if I'm getting a garbage plate, but
What would be,
I think that's-
what would be your go-to?
I'm a old school cheeseburger plate, everything on it. Cons?
Mac salad,
Mac
home
salad,
fries,
home fries. Yep.
everything all over everything. And then I eat it separately. I compartmentalize the food.
So Andrew, this guy in college, so I've known him since we were 15 years old. And in college, we drive back. We went to the University of Buffalo. So it's like about an hour drive. We drive back to Rochester. He could polish off 2 garbage plates in college.
Yeah. I think I could barely finish one now.
Yeah, for sure.
The one was a lot. I don't think I finished the whole thing. I got it,
no
I tried
way.
it, got the taste, and
Sure.
until next time.
Yeah. So that's a Rochester treat.
That's what I was told.
Yeah. Back to business. Cons, you want to give us the updates?
Back to business. So Andrew's from Vanguard, and I think some of our listeners know the name. It's a household name. But I've actually had a number of conversations where people think that we might compete with each other in the sense that, I manage my money at Vanguard, and they don't understand that we actually like a lot of Vanguard's products, and you have a whole slew of investments. But one thing I'd love for you to kind of touch on is maybe a general overall market outlook on what you're hearing from maybe your research department, positioning and things like that.
Yeah, absolutely. And I have to caveat, obviously, things change. And
Yes, they do.
Things change, and
Yeah.
because things change, our view on things changes as well. So hopefully there won't be any.
Yeah, we're going to hold you to
bold
everything
takes,
you say
bold
today.
takes
So
exposed
yeah.
here, but the way that we do our our market forecasting and our outlook, it's a little bit unique in the industry. We're not on CNBC saying, hey, this is our S&P price target for the end of the year, or hey, we think this is going to happen in the short term. We really take a much longer term approach. So
Well, how much value does that have anyway?
Yeah.
If
I
I'm
know.
right or wrong.
Yeah.
Well, the reason we do the longer term is because we found we're actually able to be much more accurate. And short term, we feel that short term it's really hard to predict. So many things can change that.
Mm-hmm.
But if you do give a longer term approach, it allows kind of the market cycle to ebb and flow, and some of those longer term trends play out. We found
Sure.
we're actually much more accurate doing that. Now, certainly we could touch on some of the short term things that are going to happen that we think will lead to those longer term outcomes. But it's just a little bit unique in the way that we do things, looking a little bit further out as opposed to, hey, what should I be buying right now for the next 3 months?
Sure.
Or something like that. So,
Well, I guess, asking specifically, and I understand that things change rapidly. And as we head into 2024 election year, right?
Mhm.
It's, oh my gosh, what's going to happen in election year? Even though I've seen studies go both ways, right? What trends are you seeing, or does Vanguard stand that there's a chance of a recession? I hear mild recession or a light recession.
Yeah,
Just
so
interested in.
Yeah, so we
Delta.
actually thought we would see a recession this year.
Mhm.
So coming, if we rewind the tape here back to last fall, we thought we'd see a mild, shallow recession, probably sometime middle to second half of this year.
Mhm.
Now, as we sit here in September, obviously that hasn't happened. We have pushed that out a little bit. So we
Mhm.
think, potentially sometime mid to the second half of next year, we could see that. We have actually downgraded the probability of that slightly. So, coming into the year, we were thinking 90% probability, push that back, 70, 60% probability. That is still our base case. But what is interesting is you might hear, soft landing. Hear that
Oh
term
yeah.
gets thrown out a lot. A lot of the underlying factors and a lot of the underlying numbers that we're using to come up with our recessionary case are very similar to the people and the economists who are coming up with the soft landing. So really, no matter what you call it, soft landing, mild, shallow recession,
Mhm.
we're pretty well aligned. But broadly speaking, I think the important message is that we don't think it will have a tremendous impact on the broader markets from a return standpoint or you know the majority of the economy. We don't think it's something that clients really need to be adjusting their portfolios to.
Sure.
You might hear about it. It might cause some additional volatility, but really, unless you specifically your financial picture, your life and well-being has dramatically changed, it's not
Mhm.
something that we think clients should necessarily be adjusting portfolios or spending a ton of time
And who
worrying
gets
about.
that right? How many times have we seen mistakes?
Oh yeah. Trying to time the market. I mean, we were just talking about this recently where it's like everybody wants to be right.
Yeah,
Like, I'll just move to cash until things seem better. Well, by the time things seem better, you miss the boat, right?
we put out an interesting study a couple years ago. So Vanguard's Advisors Alpha. I don't know if you're familiar with the study, but it really it looks at it looks at a lot of things. But one of the areas that it looked at is investor behavior.
Mhm.
And to your point about time in the market and being difficult, generally in asset classes, investors actually realize significantly less of the return of that asset class from poor market timing. So they're either getting in too late, they're getting out too early.
Mhm.
So, if an asset class returned 5%, generally investors are not they're not realizing that same level of
Sure.
return just because of the behavioral component.
Yeah, emotional aspect to it.
Exactly.
Yeah.
Yep.
And I feel like people make more mistakes in a down market and recession. You think about 2008, you think about September 11th, you think about those years where people lost 20, 30, 40 plus percent, cash out and go into a safe vehicle because it's making a positive rate of return, 5, 6%. And that's kind of the environment we're in now. You buy a
Yeah.
CD, what do you, 6 month CD, five, five and a half,
Yeah.
right?
Just locked
It feels good.
just locked in 5.6 for
There
one
you
of our
go.
clients about a half hour ago. Yeah, absolutely. But yeah, and to that point, I was going to bring it up a little later, but since you were talking about Vanguard studies, the power of working with an advisor, like Kant said, a lot of times people think that we work against each other, and it's like a Vanguard study came out years ago that showed your average advisor over time makes you an additional 3%. Now that's not just market based, but like in the grand scheme of whenever you have a financial situation, you go to your trusted advisor, whether it's uh, should I finance a car or pay cash? Should I, take out a home equity? All these different life events financially. When you work with a trusted advisor, on average, your rate of return in life is about a 3% better rate of
Yeah,
return.
that's the Advisors Alpha study
Yeah.
that I was mentioning, and there's so many components to that. It's the asset allocation, it's the planning, it's the
Mhm.
tax strategies, but the biggest
Yes.
component of it is the behavioral coaching, and it's really
Yes.
just
Yes.
stopping clients from really being their own worst enemy and keeping them invested, keeping them stuck to their plan, keeping them on track,
Mhm.
and really taking that emotional aspect out of it,
Yeah,
which can really be detrimental as we've seen time and time
absolutely.
again.
I like
Absolutely.
I like what you said earlier in the show when you said that things are ever changing and evolving. And that's so true. I actually did a podcast recently with a consultant. And so he talked about different programs on budgeting and reducing debt and things like that. That's one aspect, one element. And he mentioned programs like a Dave Ramsey. It's not like we can give all the answers. If I were to give you the top 50 stocks right now to buy today, what happens afterwards? What happens 6 months, 12 months, 5 years, 10 years? You just hold on to those stocks. Maybe they're in favor today, maybe they're not tomorrow. You don't know. And each company is very different, right?
Mhm.
But it's the coaching. And so when you talk about the 3% value that we bring as advisors to them, it's all encompassing, right? It's the plan, it's the estate, it's the tax limitation, it's keeping more of what you're making and what you're earning. Maybe some other strategies on how to implement something that's more efficient for the client and the family as a whole. So yeah, I think that 3% is pretty close to what a client might expect in overall implied value.
And the thing about that too, it's control the controllables. You
Mhm.
can't control if the market is
No,
going
we
to go
can't.
up or
Yep.
down. Even though I'm sure some of your clients might think that you could or
Sure.
wish you could, but
Sure.
the keeping the portfolios efficient, keeping the portfolios in line from a tax standpoint, lowering costs on the investments. Like these are all things that are ultimately controllable. So if you are able to focus on those things, it's going to give you so much of a better probability and chance for success because you've got that part taken care of. So now, up market, great, fantastic. That's adding to it. Down market, it's not going to be as detrimental because
Yeah.
you've always maximized all these other areas.
Yeah. And isn't that true too? Like you look at portfolios and how focus on the things you can control. Isn't that kind of true about life too?
Yeah.
Like when I really look at our like political realm right now, and we're not going to ask you for your political affiliation or
Oh,
anything
we're not?
crazy here
Appreciate
today.
that.
Uh, but just jot it down real
Yeah.
quick now. But like you look at all this stuff, and I start watching TV, and whether it's Democrats, Republicans, I could care less. Like I almost start getting like a panic sensation of like, what the heck is going to happen next year? And and all these people to a certain degree are clowns. I mean, I'm like, I can't believe this is the best of the best with some of the people that are on TV. And then you have to take a step back and say, well, regardless of how amped up or worked up I get, I can't change any of this.
Mhm.
So I should focus my time on the things, to your point, Andrew, the things that we can focus on, the things that we have influence on, right? And let's work on those things in my local sphere to control that to the best of my abilities,
Yeah,
right?
and you talked about it earlier, and we put out a paper on this, the last kind of election cycle, and I'm sure it'll be getting refreshed with
Sure,
next year,
sure.
being a presidential election year. But there have obviously been time periods where Democrats have been in control, and we've had good market years, bad
Hmm.
market years. Republicans have been in control, good market years, bad market years. Over time, it really evens out to where no matter who is in power in Washington, generally is about the same. And
Yeah,
I think that it could be a good reminder for clients, especially how it seems now for a lot of people, politics have become a really emotional thing. It's
oh
it's
yeah.
oh well, if this happens, like I gotta pull all my money out because this is going to be terrible, or if that, and
Yeah,
it can be a good reminder that hey, all of these things, they're probably you're probably overreacting here, and
yeah,
history has shown us that really regardless of who's been in power, markets have done fairly well.
sure,
As long as you zoom the chart out far enough and you have
exactly.
the patience and you have that long term approach, generally things work out pretty well.
Yeah, for sure. For
Yeah, I
sure.
think of like a couple different election cycles where folks would have a very healthy discussion about who may or may not win. And sometimes you get that right, but you get the outcome wrong as far as what happens with your investments. So, one political party, Democrat, Republican, whoever it might be, this is the outcome I think is going to happen. And to your point, I got to cash out.
Hmm.
How many times have we seen that
Yeah,
you get the one part of the equation correct, but you get the outcome wrong? And trying to time the market, I've never seen it done correctly, including myself.
Well, and the other thing too is, especially in leading up to elections, when you
yeah,
have people campaigning, they're talking about what they would do or could do, and
And what they
we
don't
we
do.
we put out a piece a couple years ago talking about, hey, a lot of these things, they never end up coming to fruition exactly how, or
Mhm.
they rarely end up coming to fruition exactly how they were proposed. Maybe they never happen at all. Maybe it's a significantly scaled down version of what was initially thought. And a lot of these proposals that people get worked up on, or try to make, tactical decisions about, it really can be difficult
Yeah.
because a lot of these things may never
Yeah.
happen.
Almost
So
foolish, though, I'd argue. Almost foolish. You make a lot out of nothing, right? So,
Well, media, politics, inflation, interest rates, it leads into temptation. It tempts you to
mhm,
say, geez, I can
mhm.
grab five and change on a CD. Why am I in the market? Why don't I just put everything into cash? And like you mentioned, when do you get back in? I mean,
Yeah.
if your target is really 10, 20, 30 years into retirement and then some, why are you trying to monkey around and tweak your portfolio to try to make 5% so you feel great today, but 10 years down the road, you're going to say, man, I really missed a great opportunity. And last year, even when you look at NASDAQ, you look at S&P, you look at some of the bigger, broader indexes that were down, not every sector was down and not everyone lost money last year. There were places where people did make money. One thing that does kind of scare the crap out of me is people saving for retirement. And I think of the younger generation, folks that are 40 and younger who don't really, I don't think any of us really have a pension. You might, Andrew, I don't know, but pensions are a thing of the past. So really, we're all going to be reliant and dependent on our own savings. And I'm not seeing the savings from this younger generation in their 401ks and their retirement plan IRAs and being proactive. It's not something that I think they can forget about. And it's a shame because there's not going to be time when these people are 55, 60 years old saying, yeah, I've got 5 or 10,000 put away in a Roth IRA. It's not going to cut it. And you're left with Social Security. That really, I don't know how else to say it, but I feel like more has to be done. And I know the government is making some changes on implementing 401ks and having things become a mandatory thing if you're in business like New York State. California's made some adoptions. What do you guys? What's your take on that? What do you guys seen happen?
yeah, so it's a really interesting question, and it's one thing that, I look personally at, and I think one of the tremendous benefits of working at Vanguard for as long as I have, and really starting my career out at Vanguard at a really young age was, I got a crash course in financial education
Mhm.
that a lot of my peers, people my age, don't get. So, just that knowledge of how important starting young from a saving
Were you
standpoint.
fresh out of
I
school?
was, yeah, it was
See,
fresh
that
out
is
of
And you
fresh out
started
of
fantastic.
and you went
school.
to Vanguard?
Yeah, so
That's
graduated
Wow.
Penn
incredible.
State. Yeah,
Yeah.
Vanguard was my first job out of school, and
I got a
still
question for
here.
you. Why Vanguard? Why? What was? I mean, why financial? I don't know what your undergrad studies were, but why? What's the motivation?
Yeah, so I was a marketing and econ major. So I was from the Philadelphia area. Obviously, Vanguard was a huge employer in the area.
Mhm.
Thought that I always wanted to kind of get into the financial area or realm, but really, wanted to stay kind of close to that Philadelphia area.
Is
Did it.
that their hub? Is
It's Valley Forge,
Oh,
yeah,
oh, that's right.
Malvern
You
Valley
said that
Forge,
earlier.
yeah.
I
So it's
apologize.
it's outside of Philly. So I didn't
Mhm.
really see myself, going to New York City. I really didn't know anybody there. And the other thing that really appealed to me about Vanguard was, it was more of a, what is it, more of a mission driven company and organization. So one of the things that is unique about, Vanguard is it's a unique ownership structure. So, instead of, we don't have a share price, or, we're not a publicly traded company. We don't have a wealthy, founder family and high up.
Hierarchy.
Exactly.
Yeah.
So really, Vanguard, the money that is made goes back into the funds to lower the expense ratio. So it's, instead, we're owned by our shareholders, and we feel that the best way of, kind of giving back those profits to our owners is continuing to lower the cost for them so that
Yeah.
they can make more money. I thought that was unique in a financial Wall Street type environment where, a lot of the things you see on the news or TV or movies and whatnot is
Mhm.
just about kind of the greed and excess and the
Yeah.
money. And it
Like
was,
the Wolf of Wall Street kind of stuff.
correct.
Yeah.
It's a very, especially being suburban Philadelphia, just a very different
Vibe.
vibe and feel to it. And it was something that I felt comfortable and fit my personality. And obviously, I'm still here 10
Yeah.
years later, so I
Yeah.
feel pretty good about that decision.
That's awesome. I mean, I don't have the traditional financial advisor background or story. I mean, I left a casino after a few years of consulting and went to a bank, and I remember getting this check, and I'm first generation. My parents both became U.S. citizens, and I knew this. I knew that the way to save for retirement was through 401k and all that, and I knew you bought stocks low and sold them high, hopefully. But that's kind of the basics that I knew. And so when I left my job, I can tell you from experience, I empathize with a lot of these people that don't understand what retirement really means. I got a check for around 20,000. I paid taxes and penalties and had no idea, and I thought it was just leftover money that I had saved over the course of the years, which is true, but had no idea. I had nobody at the bank. I can remember having 20, 30,000 in a savings account, nobody ever talking to me and educating me. So when I go to these meetings where I work with businesses setting up either simple IRAs, 401ks, and some of these people raise their hands and they're 40, 50 years old and say, look, this is the first time I've ever saved in a retirement plan, an actual retirement plan that's designed for that. I said, yeah, I remember that. I got that check and I got penalized in tax. And I had no idea. Nobody called me.
Yeah.
So that's good that you got a
I,
really
I
fresh out of school.
I
Jumpstart.
was lucky, and we have a program at Vanguard called My Classroom Economy, where we try to actually get financial literacy and financial education, into kind of school programs to
Mhm.
just start at a young age, teaching people the importance of saving money and, about some of these financial
Yeah.
topics. I think that obviously we'll see what happens. And I think that would be huge as far as schools starting to make that more of
I
a
agree.
Yeah, that
priority.
always
And
killed me. Like you graduate high school, you can't balance a checkbook for Pete's sake. You don't even know how to write a check. And it's like,
mhm.
why aren't they teaching stuff like that in
What was
school?
the
Well,
class we took? Was it home and careers? Is that what it was called?
Home economics? Is
Home
that what
economics? I don't know.
So
oh,
I had in high school, I had a personal, it was an elective that you could take. And
yeah.
I took it. It was personal finance, but it was, hey, this is,
What
this
high
is how
school did
you
you go
write.
to? Personal
Yeah, where was
economics.
that? We
Yeah.
didn't have that.
Penridge High School,
Yeah.
public,
Sweet, sweet,
public
sweet.
public school outside
Yeah.
of Philadelphia. It was an elective, but it
Great.
was, hey, here's how you write a check.
Yeah.
Here's a checkbook. It was, basic stuff. Um, but I think now, and you think about the internet, and you see the things and some of the disinformation that is out there on, oh, well, you should just buy this stock. And you saw a lot of it during the pandemic with,
Still see
oh,
it.
you should buy this or that or do this or that. And a lot of it is just really poor financial advice,
You mean
but
buy gold? Take everything you own and just buy gold?
or get a million loans and buy 100 houses.
Oh
And
yeah. Did we talk about that? Or buy the index universal lives or the variable?
there's a, I
Life
mean,
insurance.
there is a lot out
Ah,
there. And
those make me mad when I see those.
It does.
Because we have young business owners that will like reach out to us and they're like, Dave, why didn't you tell me about this? And I'm like, because it's a semi scam. It's not totally fictitious, but like a lot of the perks they talk about are just not realistic, right?
Mhm.
But yeah, sorry, I didn't mean side
No,
tangent. It
no,
just gets my
it's
blood boiling.
yeah, I don't know, it is something I know for me, the real eye-opening, I forget what, paper or what I was when I read it, and it looked at the time value of money, and it was looking at, hey, if you invest, X amount on a monthly basis at 25 and you get, 6% return after 40 years at 65, you'll have this amount. Well, if you do the same thing at 35, you'll
Mhm.
have this amount. You do the same thing at 45, and just showing how, through having that time and having that money invested, and those returns compounding over
Yeah,
time, just the
consistency.
dramatic
Yes.
impact of, still investing the same amount, but just the time, how much, you know, more it grew. It was like, okay. we need to prioritize, maybe deprioritize some of the fun things that 25-year-olds do,
Yeah.
and prioritize putting some money away as early as possible.
Yeah.
I was just having a conversation with a younger advisor, maybe 2 or 3 years into the business and, starting out, and I think I shared this with you, Dave. To say right now that I rewind time and I'm 23 years old, fresh out of college, just starting a business, it's a very different feel than it was 15, 20 years ago. So much more education, so much more information available. And like you say, wrong information
Mhm.
available, readily available on the internet.
Yeah.
Not to mention all this promotions through these social media apps. I have knowledgeable people who are CEOs, CFOs. I have family members. I have some that are accountants, lawyers calling me and saying, "Hey, I saw this great investment idea." And I'm like, scratching my head, like saying you saw a 10-second clip, heard all the benefits, none of the downside, and you're ready to dive headfirst into this thing.
Yeah.
It,
It's
Yeah.
insane.
it sounds too good to be true. It generally is.
Probably is. Yeah. And not to sound like an old man, but like that's part of my beef with this new generation is like exactly what you said, Andrew. That's the truth. Like investing, for lack of better terms, it's boring. It's just consistent, boring vanilla over time.
Hmm.
And like, hey, 40 years later, I have a big pot of money. Like, great. But like a lot of these kids now, and especially after COVID, it was like, oh, did you buy Delta? Because Delta was at zero,
The
at
meme
$10.
stocks,
Well, yeah.
the meme stocks.
And all these like stocks went through the roof and they thought they could do it all on their own and they're going to make $1 million overnight. And then you got into crypto and the crypto craziness and like you see all of that, and the big catch to crypto was it's not correlated to the market. Well, we saw that it was actually more volatile than the market, right? And so a lot of these kids, again, sounding like an old man, like they want to be millionaires overnight. They want to be the CEO, but they want to take the elevator, not the stairs.
Right.
You know,
Yeah. The single digit returns year after year after year
yeah.
after
How boring,
right.
right? It's just crazy. But
But honestly though, the education thing, I think I think it should start at the middle school to high school level and maybe I mean just teaching basic things. You know how many
Mhm.
adults I meet with that don't know the difference between a credit card and a debit card? A credit card and a debit card.
uh,
When I used to work at the bank, I mean, this is not long ago, 2006, 2007. He'd come in with overdraft fees and, oh, I thought that was tied to my credit card. It doesn't work like that. Yeah, it looks and acts a lot like a credit card, but when you swipe that card, if you don't have the money in your account, you're going to
yeah,
be negative.
yeah,
The basic fundamentals, and like you guys said, I mean, beating a dead horse, it's just consistent, habitual activities. It's not life changing. It's not like you have to follow a very uh, abrasive plan where you have to eat peanut butter and jelly and live in your
yeah,
car and pay off massive debt. Those stories you hear about all the time.
It's
I
all the
think Kramer's one
avocado.
of
It's all
them.
the avocado toast. That's
See?
my generation. Can't.
See?
yeah, yeah. It really is.
I mean, think of what we pay for now. We go to a coffee shop and pay 5, $6 for a cup of coffee, and we're just fine with that, right?
Yeah,
But then people don't want to spend money to sit down or even time. I think that's more what it is time. People want to get rich quick now, right away. Making 8 to 10% a year for, over a 20-year period is not good enough when you can make 3, 4,000% in crypto. And the reality is you don't hear about all the
dude.
horror stories of people
Yep.
that got either hacked or lost the money or whatever.
And you hear some victories. Like I
There
know
are.
I know a friend that I think it was AMC stock. You remember when I was going through
Yep.
all that crazy
Yep.
stuff? And it was like my buddy told me he made like $60,000 in like 3 weeks. But like how easily that could have went the other way, right? But so he'll tell that story to 10 people, and 10 people will think they could redo that with a different stock. Well, I'll just wait for the next one. And it's like, and this in the same with crypto. I have people that did, I made 80 grand, Dave. Oh my gosh, this is great. Like I don't think you realize how lucky you got, right?
Mhm.
And then they think they're experts now. And that again, going back to the COVID days, that was a lot of like my millennial investors is they got lucky after right after COVID hit and the world was going to be shut down forever. The market dropped what, like 20-25% real quick, like within a couple of weeks. A lot of those people bought then. So then when it started turning around, they made a lot of money very quickly. And so they became experts, right? Like I don't need a financial advisor. I can do this in my sleep. But then when the trades became more difficult and everything became fair market, right? You start running into that, and now they're like, "Oh, this isn't as easy as I thought," right? And you start sweating a little bit, and then they start taking losses, and then they start acting even more emotional on the downside. So, just kind of nuts.
What do you guys think about the Fed and what they're doing as far as correcting the economy and slowing things down? If you think they've done a good job, I mean, I ran about this all the time that I feel like this should have been addressed years and years and years ago when the economy was doing well and booming and robust, and we had the ability to increase rates over time, and now we're scrambling at the last minute because if we don't have that, what other mechanism do they have to either slow things down or dial it up? I don't know. I'm not a fan of what's happening right now, but curious to hear what you guys think.
But I do think you have to give kind of a little bit of credit because if you look back, they did start raising rates, and we were raising rates kind of going into COVID. And then, when COVID happened, you just had basically rates fall through the floor. And at the time,
Yeah.
nobody really knew what was going on. And at the time, like that was, seemed like the correct decision to kind of keep the economy moving and jumpstart things. And unfortunately, the flip side of that is now, we had to start coming back up from a much lower point than where we were at in 2019. It's certainly even at here at Vanguard, we didn't think we would see rates where they're at now. Originally when rates started coming up, we thought final landing spot would be significantly lower, and then as we've kind of kept going and seen, hey, inflation isn't coming down as quickly as we thought it was going to. Wage growth is not slowing, as
Hmm.
quickly as we thought it would. Unemployment is really not increasing to the level that we thought it would. Maybe we're going to have to keep going higher and higher and higher. And then we're kind of at the point where we're at now. I mean, still the story is yet to be, we haven't reached the final page yet. We
Mhm.
haven't
Yeah.
put the end and close the book on this, but all things considered, up until this point, from a soft landing standpoint, that's something that the Fed has never historically been able to achieve. So,
Yeah.
if they are able to actually achieve that soft landing, or even if we do have a recession and it's a mild, shallow one, and the impact is relatively minimal, I do think you have to give them credit, and it could have been a lot worse.
Yeah.
I think it
Yeah.
is, what would you think?
Yeah. Andrew, I'm curious on your take on commercial real estate, on the commercial real estate market in general, and with these higher interest rates. And I don't know if you're how in tune you are with like all of the what do I want to say? After after like 10 years, the loans have to kind of recalculate based on current interest rates. And
Yep.
any insight or your take on it?
Not a ton.
No?
It really is probably going to be. We'll wait and see.
Yeah.
Because to your point, a lot of those commercial real estate, they were able to refinance,
Hmm.
and they were able to get pretty low rates, which is allowing them to kind of weather a lot of this.
Hmm.
Now you fast forward, and maybe you've lost a lot of your tenants because of people moving or work from home, office. I mentioned live in Philadelphia. Office capacity. Most people are hybrid. They're
Hmm.
3 days a week. So then, what's the trickle down impact of all of the local restaurants or business owners, let alone the companies that now maybe you don't need as much real estate or as
Yeah.
much space. I think we are so. I mean, I don't want to say new, but really, if you think about where we were a year ago, 2 years ago,
Yeah.
we're kind of slowly stepping out from this. We'll see what 3 4 years down the road looks like. We'll see where rates are,
Yeah.
if they're still elevated. We think that they'll probably start to come down. What level they come down to,
Hmm.
will be interesting. But
Yeah.
it's certainly a great question, and unfortunately, we don't have the crystal ball. We've got
Sure.
some
Sure.
ideas, but
It
it's going to
concerns
be.
me though, I'll be honest with you, and it's this talk of keeping interest rates higher for longer. And I forgot the number, but it was something crazy. Like there's like uh, 5 or 10 trillion dollars worth of commercial loans that need to be restructured in the next 18 to 24 months. And so you think about it, you rewind 10 years ago, you got a commercial loan for 5-6%, which is a steal in the commercial, real estate space. And now you're refinancing at potentially 9-10%. So your payment's doubling. And then to your point exactly, if I own that big skyscraper downtown Manhattan, let's say, and I used to have a 5% mortgage, now I have a 10% mortgage, and now I have maybe 60 or 70% occupation because you work at the office 3 days. Susie works there 2 days. So now I only need one office for the two of you. So now I have half the tenants, double the payment. And now you take that across the country. I mean, I heard in San Francisco right now, there's a 33% vacancy rate in commercial real estate. So
Wow,
one
there's
out
a
of
couple more reasons than
well,
just
yeah.
those-
Fair.
there.
Yeah, agreed. But they say across the country, I think it was 26% vacancy rate in commercial real estate right now. So it's like, when we look at trends and bubbles, right? Bubbles are the things that we want to avoid. And when people argue about the residential real estate side, I don't see, because everyone's like, the prices are through the roof. And I'm like, yeah, but there's like low inventory. Nobody wants to sell because I have a 3% mortgage. Why do I want to sell out of my house? And then where am I going? Right. So I don't see the bubble forming as bad in residential real estate versus commercial, I guess. So that's like a thing that I've been kind of keeping my eye on, because the Fed could potentially deflate that bubble if eventually in the next 12, 18 months, they're able to start decreasing interest rates. Like they could really avoid that.
And that's what we think we'll actually start to see the second half of next year.
24?
So second half of 2024, we do think we'll start to see rates, slowly come down.
Mm-hmm.
Now, where that final landing spot is,
Sure.
I think it is ultimately up to interpretation. And you've kind of seen a couple different things. Is it going to be 4? Is it going to be 3? Is it going to be 2? Our view is we also are in the camp that we think it is going to be, higher interest rates, higher for longer, higher for the foreseeable future. Certainly not the levels that we're at now, but significantly higher than the
last
0 or
the last decade. Yeah, that's
Absolutely.
fair. If they can pull back, call it 200 basis points, like I think that would be a decent, like sustainable.
We think by the end of next year, somewhere, for the Fed funds, somewhere in that 4.5 range is
Really
what we are thinking at the moment.
Wow.
So
Okay,
now
great.
we'll see what happens.
Sure. A lot can change.
See if we're, how close or how accurate that is. But at least, and a lot of it's going to depend on ultimately, hey, are we starting to see, or the trends that we're seeing, inflation, unemployment, wage growth, like do those trends continue on the trajectory that they have? Do they start speeding up? Do we start to see some of those things come down maybe faster than they have been, or do they flatten and level out?
I think some of the lower to middle income folks who are on a fixed income and a budget, and right now will get some relief if that does happen, because think of the cost of gas and food. Those are things that we can't say, I'm not going to go and buy food this month, right? We all have to eat. And the folks that are on a fixed income, I feel like are feeling the squeeze a lot more than others who can continue to work and make more money and wages and things like that. The cost of gas. I mean, I just filled up my wife. We were talking about this the other day. $106 for was she? I think she's premium. We paid $5 a gallon. I haven't seen $5 a gallon in a long
Wow,
time.
$5.
Yeah,
I mean, like
nuts.
460 on my end of
460.
town. Yeah.
I mean, that's what were they, $1.80 4 years ago, something like that.
Yeah.
Well, 4 years ago, no one wanted. Well,
No one wanted to put
I was
gas
going
in.
to say 3 years ago, no one wanted to go anywhere. So
Yeah, that's true.
That's true
I
too, right?
I remember getting the phone calls when oil was negative, and it was, wait, what does this mean?
Do you remember futures?
Yeah,
That was the
I remember
craziest
that.
You
thing.
go to the gas station, they give you money to put in gas.
I had people ask me, they're like, wait, so I could take barrels of oil and get paid? I was like, no, you don't want to do this. Like, stop.
Yeah. Something is wrong right now.
It's like, no, I can find this. No, stop.
Dude, that was crazy.
Yeah.
Like they were trying to explain it, and it's like nobody could really explain. Yeah. crazy. But I do remember, like, real quick, and again, not to get political, but I remember my Republican friends, when Trump got, like, he was getting out of office, they took pictures for Facebook of the pump, because in Facebook, like, it'll show like a memory, like 4 years ago this
Timeline.
day or 3 years ago. And they took pictures at the pump. It was $1.89 when he was leaving office. It's like, oh my God. Now you could point at a million different things. And again, like, we could debate all day on this stuff, but to see the cost go up that dramatically in just a couple of years, because I remember people doing that and thinking, like, whatever, it's not going to go up that high. It's like, it's actually, like, has happened. Like, that's crazy. But we've also shifted our focus on where we're getting energy now, right? And that's been the cause of a lot of this stuff too. I don't agree with it all, but we could save that for a different day.
So no EV vehicle for you yet.
No EV
Not yet?
vehicle. Yeah.
Yeah, I'm not quite there. Not quite there. Well, I think we ran the full gamut. Andrew, I appreciate all your time today. Thanks again for
Yeah,
listening
thank you,
to
Andrew.
Pennywise
Appreciate you
Financial
guys having me.
Podcast.
Yeah.
Great. Andrew White
Yes.
from Vanguard. Thanks again.
Thanks, guys.
Thank you, brother.
You've been listening to Pennywise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is Pennywise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA, and SIPC.